Buying a 3 or 4 unit property with an FHA loan might be the closest thing to a real estate cheat code, but only if you understand the rules. And here's the problem: most buyers don't know these rules, and sadly, a lot of loan originators don't either. Yes, you can buy a 3 to 4 unit property with as little as 3.5% down, live in one unit, and rent out the others. But FHA adds extra qualification layers that can absolutely kill a deal if you're not prepared. In this video, I'm breaking down exactly how FHA qualifies you, how rental income is really used, what self-sufficient actually means, and where most people get this wrong. What is a 3 to 4 unit FHA loan? An FHA loan allows you to purchase a single-family home, a duplex, a triplex, and a 4 unit property, as long as you live in one unit as your primary residence. This strategy is commonly called house hacking. You live in one unit, and the rental income from the others helps offset your mortgage. But once you go from 2 units to 3 or 4 units, the rules change in a big way. Owner occupancy rule. This part is non-negotiable. To use FHA or a 3 to 4 unit property, you must live in one unit. It must be your primary residence. You must move in within 60 days of closing. If you're trying to buy a straight investment property, FHA is not the loan. This is about living in the property while building long-term wealth. Down payment and loan limits. The minimum down payment is still 3.5%, even on a 3 to 4 unit property. What does change? Loan limits are higher. Limits vary by county. 3 to 4 unit properties have much higher caps than single-family homes. So yes, you can buy a more expensive property, but only if the income math works. Credit requirements. FHA is more flexible with credit, but it's not a free pass. Most lenders look for a mid-500s to low 600s minimum score, solid recent payment history, limited major derogatory events. What matters most isn't the number, it's how you've handled credit recently. Income and rental offset. This is where most people get confused. This is the part almost nobody explains correctly. For qualifying your debt to income ratio, FHA does not automatically use all the rent. Example, 3 unit property. To qualify you, FHA will look at 2 rental units only. It uses the lesser of the market rent or current rent, then applies a 75% factor. That reduced amount is used towards your income when calculating your DTI. But that's only step 1. The self-sufficiency test, critical for all 3 to 4 units. On top of DTI, 3 to 4 unit FHA loans must be self-sufficient. What does that mean, you ask? FHA will take all 3 rental units, use market rent from the appraisal, apply the 75% rule, and that number must be equal to or greater than the monthly mortgage payment, principal, interest, taxes, insurance, and mortgage insurance. If the property fails the test, the loan is denied, even if your personal income is strong. This is one of the biggest deal killers in FHA multi-unit family loans. Reserve requirements, another common surprise. For 3 to 4 unit FHA properties, lenders require at least 3 months of reserves. That means 3 full month payments of total housing payment, verified assets, funds left over after closing. A lot of buyers don't plan for this, and a lot of loan officers forget to mention it. Property and FHA appraisal. The property must meet FHA standards, safe, sound, and habitable. Each unit must be legal, functional, livable. The FHA appraisal also determines the market rent, which directly impacts both your DTI and the self-sufficiency test. Common mistakes to avoid. Here's where people usually mess this up: assuming all rent counts towards qualifying, not understanding the self-sufficiency rule, forgetting about the 3-month reserve requirement, buying a property that fails FHA condition standards, thinking income alone can fix bad numbers. With FHA multifamily, the property has to qualify just as much as the borrower. Here's an example. We have a purchase price of $1 million. Your down payment of 3.5% is only $35,000. You have a base loan amount of $965,000. The monthly housing payment breakdown: your principal and interest at a rate of, let's say, 6% at a 30-year fix. is about $5,785. Let's throw in property taxes of, let's say, $15,000 a year. We are in New Jersey, for example, and taxes are expensive. That's $1,250 a month. Let's call homeowners insurance about $3,000 annually, $250 a month. FHA mortgage insurance, also known as MI, is a factor of 0.75. So let's get the loan amount of $965, multiply that by 0.75% equals $7,238. Divide that by 12, and our number is $603 a month. Total mortgage payment, also known as PITI, is the component of the monthly principal and interest, in this case $5,785, taxes of $1,250, and insurance of $250, and your FHA MI of $603 for a total monthly payment of $7,888. So our rental income calculation for a 3 to 4 unit FHA rule. Rental income per unit, $3,500. Number of rental units, 3. Gross monthly rent, $3,500 multiplied by 3 equals $10,500. We take the 75% rule, and that will equal $7,875. Self-sufficiency test. This is the deal breaker. For a 3 to 4 unit FHA loan, the property must be self-sufficient. 75% the market rent must be equal to or greater than the total mortgage payment. So $7,875 is less than the mortgage payment of $7,888. The result is fails self-sufficiency by $13. Even though this is extremely close, FHA guidelines are binary. Short by even $1 means the loan does not qualify. What this means in the real world, strong borrower income does not fix this. Higher down payment, lower rate, lower taxes, or higher rents would be required. This is why many 3 to 4 unit FHA deals fall apart late in underwriting, and why this rule is often misunderstood or never explained up front. Quick fix examples. Any one of these could make this deal work. Slightly higher appraisal rents, lower interest rate, additional down payment, lower MI factor, if applicable, reduced purchase price. Here are my final thoughts. A 3 to 4 unit FHA loan isn't just about buying a house. It's about changing how you pay for housing. Instead of rent being a pure expense, it becomes part of the strategy. But this only works when the numbers are done correctly, not based on assumptions on TikTok math. If you're thinking about house hacking with FHA and want to know if a property actually qualifies, reach out. One conversation can save you years of mistakes. And if this was helpful, like, subscribe, and share, because this information most people never get told.